for this video, we're going to be dealing with the My First Texas Home. Get something to drink, a pen to write with, because when we're finished with this video, you'll know everything that you need to know to make sure if this is the program that you want to move forward with. The first time homebuyer eligibility requirements: you have not owned and occupied a primary residence in the most recent 3 years. And this includes non-purchasing spouse, meaning that you're married or you have a spouse in the state of Texas. And if that spouse is not on the loan for loan qualifying purposes, that spouse cannot have had ownership in a primary residence in the most recent 3 years and occupied it. Okay, so that applies to that person as well. And any other adult who will have ownership interest in the property. Okay, meaning the name is going to be on the deed. If you're applying, say you, your spouse, and your mother or mother-in-law, you're all going to occupy the property, ownership interest, meaning you're qualifying and you're going to own that home on the deed, then you cannot have had ownership in a primary residence that you occupied in the most recent 3 years. And we're going to use your tax returns, your most recent 3-year tax return, to make sure you meet that test. And so if you want to know about how to get the documentation that you need before you even apply, you might want to watch this video here or here. I don't know where it's going to be on the screen, but that's a great place to go to understand where you can gather those documents. But here's the deal. Just as in life, there's exceptions to everything, right? So there's exceptions to this first-time homebuyer rule as well. And here's the deal. If your home buyer or a spouse is a qualified veteran, meaning you've been honorably discharged, have not previously qualified and received a home loan or mortgage through a mortgage revenue bond program, okay, using the qualified veteran exception for first-time homebuyer status, then you have a loophole to get around the first-time homebuyer requirement. And if the property that you're looking to buy is in a qualified targeted census tract, then you don't have to meet that first-time homebuyer requirement test either. So the next section that we're going to go into has to deal with your FICO, your credit scores, and debt to income requirements. 620 minimum credit score on all of these deals to be able to unlock the door. If you have some challenges with credit or anything of that nature and you want to learn how to fix or better your credit on your own for free, watch this video here to show you how to self-remedy those things. The minimum debt to income ratio at 45% does not require any reserves, okay? And so if your debt to income ratio is 45.01 to 50%, that would be the maximum, 50% for this program, then you have to have a 3-month principal, interest, and tax insurance reserve requirement met. So let's say your house payment is $1,000 after closing. When they say $1,000, I'm talking about principal, interest, taxes, and insurance. Then after closing, you would have to have a $3,000 liquid position or in an account that could be liquidated that qualifies to meet that reserve requirements. Also, this is a new wrinkle with this program, but whenever your PITI, principal, interest, tax, and insurance payment exceeds 1.5 times or 150% of the current rent, then you also have to have a 3-month reserve requirement. If you have a $1,000 rent and the new proposed house payment is $1,501, well, then you would have to have those reserves. If you have a spouse, that doesn't mean you have to double the reserves. It's just 3 months reserves if your new house payment is going to be 150% more than your documented rent. And if you're 45.01 to 50%, you also have to have that 3-month reserve cushion. Not a bad thing. I think it's a good thing because it assures that you're ready to purchase a home, because it's just not about buying the home, but it's about enjoying it and it not being remorseful to you because you're house rich and cash poor. If you need some help understanding where you are, don't hesitate to reach out. You can get our contact information in the description below. Now that we have a good understanding of the FICO requirements, let's talk about the income limit requirements. With the income limits, you have to understand that as a lender, we're looking at all of these potential income sources that you see here on the screen. Let me scroll this up a little bit. So we're looking at your annual wages, any annuities that you may be receiving, commissions, bonuses over those 2-year periods, any pensions, child support, self-employment, any business that you have where depreciation could be added back in, alimony that you're receiving, dividend income, public assistance or interest income. The spirit of these programs are to help those that are at a certain area median income or lower. It's not designed for people to game the system. So we're going to go through and validate that you're meeting the income requirements. But again, it sounds a little more daunting than what it is. So what I would say to you is you really just want to deal with somebody that understands these programs, because if not, then one of these things can be a gotcha if it's not brought up at the appropriate time during the application time. And you don't want to go through a whole process only to find that you weren't qualified because of someone dropped the ball, right? We don't want to have that done. So moving forward, now let's look at eligible property types. Let's scroll down a little bit here. So new and existing homes are approved with this program. Again, as long as you meet the income and the purchase price within those guidelines, then you're good to go. Single family homes, homes that are in planned unit developments, condominiums, condos, homes that are in PUDs, planned unit developments. I said it earlier, but HOAs, things of that nature. Think about those. Manufactured homes. This is something that could be done, but here's the deal. It must be real property, but by the time of the loan purchase, and we could do single and double wide homes that are acceptable per FHA, VA, and USDA guidelines. So again, you got to deal with somebody that understands the guidelines and what an acceptable manufactured home is. But you can buy one from Palm Harbor, comes to mind, and work this program to where by the time the loan closes, it has been affixed to the land. The title has been surrendered and converted over to the home is to real property. And so it's all good in the hood. We do them all the time, so it can be done. Duplexes. Here's the deal with the duplex. You can do a duplex, but it can't be brand new. Has to have been in service for 5 years. We're in December, so let's say 2019. This home would have had to have been a residential duplex from November at the earliest 2019, going back. It's 5 years old, right? Well, then you can purchase that home using one of these programs. And a lot of folks like the house hack. If you want to find out how to house hack, we got a video for you, and you want to check right up here. A great option for folks that want to get on the property ladder but want to be investors as well. House hacking is the way to go. So duplexes are something that is available with these programs. Let's move forward. Home buyer education. You must complete a pre-purchase online course, and there's a free course with the state of Texas. It's not daunting at all. And everyone, you, your spouse, whoever's going to be on the deed would have to take it. Once you're finished, you will get a certificate of completion. That's the certificate that you want to share with your lender to show that you've completed the course, and it's in your file for underwriting purposes. And if you have a co-signer different from someone that's going to be on the deed, either your spouse or an adult that's going to be on the deed, but non-occupying co-signers are not required to complete a homebuyer education course and are not subject to the first-time homebuyer requirements. Example, your parents are helping you buy. They're going to put their name, image, and likeness to help you get in the home, credit and income, things of that nature. Well, they're not living in it. They already owned a home, so they would not meet the first-time homebuyer test, but they're a co-signer, right? They're co-signing, so they don't have to take that education requirement. That would be something for you. So let's move on. Program fees are what is not talked about enough because nothing's free. This program has some of the lower fees of some of the down payment assistance programs that are out here, but nonetheless, there's fees. $150 for a purchase transaction, $85 for a tax service certificate, flood determination service, a compliance review fee of $225, and then if you are lucky enough to get a mortgage credit certificate at MCC, then there's a $400 fee for that. These fees, when you add them up, they're subtracted from the total down payment assistance. So I'll give you an example of that here when we move forward. But just know and understand that there's cost involved. So when somebody's telling you you're going to get 2, 3, 4, or 5%, understand, hey, I have to back out the fees that are associated with the program because I'm not getting the full amount. And so I want you to know that because a lot of people don't tell you that. And that's a gap that we want to bridge because I want you to be very educated and know and understand what you want to do, because when you're buying real estate, there's a lot of moving pieces when you're qualifying for a loan, and you don't want any gotchas. So now we want to talk about the insurance requirements that are required for the My First Texas Home program with TDHCA. So insurance is a big hot topic now, and there are deductibles that can be had to help defray some of those costs. But you really want to understand that function, more importantly, how it's looked at from this program standpoint. So minimum coverage amount must be equal to the loan amount or the replacement cost. Whenever we as lenders reach out to your insurance company, or whenever you get a quote on a home that you're looking to get, more times than not, they're going to provide a replacement cost estimator. God forbid something happens with the home, the land is going to remain, but replacement cost estimators is just that. How much would it cost to replace this home or put it back to a livable condition in the event of some type of catastrophe or something of that nature? So the maximum deductible is $2,500, okay, or 2%, whichever is higher. All right. Now, if your flood, wind, hail, or other perils are separate from the homeowner's insurance, then the maximum deductible for those specific things is $5,000 or 2.5%. However, is higher. So insurance is an integral part, a key part to any home loan. So again, you want to understand these things, and this is another area that there was a gap in understanding, and we want you to understand up front before you move forward. Now, here are the different loan types, i.e. down payment assistance types, that you can use with this program. So first and foremost, FHA, VA, and USDA. Those are the 3 loan types. With this particular program, there's no conventional option. And then your lender, whoever it is that you reach out to, they should be qualified to do an FHA, VA, or USDA loan. Okay? They have to be 30-year amortized loans, fully amortized, and the interest rate is fixed. There's no adjustable or variable rates. Okay? The assistance ranges from 2%, as low as 2%, up to 5%, and this is key, of the total mortgage loan funding. Okay, so example, say you have a $400,000 sales price and you're doing an FHA, less your 3.5%, then most people finance or add back in the upfront funding fee. All right, so you have a base loan amount, the $400,000 minus the 3.5% gives you your base loan amount. Then you add the upfront funding fee, the 1.75% of that base loan amount back to it to come up with the total loan amount. And then that's the dollar amount where the 2, 3, 4, or 5% down payment assistance would be calculated from. So it's calculated from the total loan amount. And then there's no level loan price adjustments, and more importantly, there's no buying down of the interest rates, because that's the other misnomer, is that there's negotiating or there's an ability to buy the interest rate down. The down payment assistance program determines what the rate is on a daily basis. And so what you're getting yourself into, and this is very important for you to know, the cost, if you will, is in that rate. And as you'll see here in a minute, all of these loans in the My First Texas Home program, 30-year amortized, and these loans have to be paid back. And because of that, this program has lower interest rates. Now we're getting into the forgivable version in this program. Same thing, 0% second mortgage that's presented, right? No payments or anything of that nature. Now this one, from the day you close to month 36, if you make all the payments like you're supposed to, month 30, then it's forgiven. So as it says, no required monthly payments and fully forgiven after 36 months. And when I say when you make your payments, I'm talking about the payments on your first mortgage. The second mortgages don't have payments. And when I say second mortgages, that's the 2, 3, 4, or 5% that's represented by the down payment assistance, but it's given to you as a second lien where no payments are required. If any of these things happen before the 36 months, if you sell it, if you refinance it, if you transfer it, then all of the down payment assistance, whatever that dollar amount was, will have to be repaid, right? And there's no closing costs other than the recording fee for the second lien, and then the prepayment penalties. There are no prepayment penalties, meaning you could pay more towards your mortgage as much as you like. It's not going to trigger a prepayment penalty. In this second version, in the second case, you would just want to make sure if you got the 36-month forgivable, you didn't pay off the loan before that 36 months. The last version of the My First Texas Home, Texas Department of Housing and Community Affairs program that I want to speak about today is the first lien, no down payment assisted and unassisted loan. And basically what that is all My First Texas guidelines apply, meaning you got to be a first-time home buyer status. All that applies. And you got to be within the income and the purchase price parameters. That's a 30-year fixed loan, but there's no affordability period, okay? And then there's no prepayment penalty. And then standard fees apply, and it comes out, as far as the rates are concerned, comes out on a daily basis. You can't use it in combination with the mortgage credit certificate because that's a different type of mortgage revenue bond, right? A different type of assistance, and you can't put them together. But with these, or this version of this program, the rates are a lot lower, okay? Probably a point and a half lower. And you're going to bring your down payment and your closing costs, but you're getting a below market rate, especially nowadays. And so there's no prepayment penalty or anything of that nature because it's just the first lien. There's no additional gift that you were getting to be either locked in for 36 months or have to pay it back at some point in time over that 30 years. This is just a below market interest rate first. So you would pay your down payment and closing costs, or get it as a gift from a qualified source, or the sellers contribute. There's a lot of different combinations. You want to get with your lender. They should be able to walk you through to give you an idea as to which flavor, the repayable, the 36 forgivable, or just the first lien, there's no down payment assistance associated, to make sure that it fits what your strategy is. Not just to get into the home, but have the foresight to think down the road. Because in my opinion, 5 to 7 years, 5 minimum, 5 years or more, what's the exit strategy? Last thing I want to say here is that any extra monies that aren't being used for down payment and closing costs in these scenarios, they cannot come back to you. The only thing that can come back to you are the things that you actually pay for out of pocket, like appraisal, meaning it came out of your checking account and we validated that money came out of your checking account. If there's earnest money or option money left over, those funds can come back. If there's any extra, then it will be handled in the following ways. It will be used to reduce a principal reduction to your loan, a maximum of 15% of the down payment assistance, or a half of 1% on the unassisted first lien to make that work. You can't get those extra funds in your pocket unless they came out of your pocket for qualified out of pocket or paid outside of closing expenses. So there you have it, ladies and gentlemen. You now understand the My First, here, let's put it back up. The My First Texas Home portion, Texas Department of Housing and Community Affairs down payment assistance programs. If you made it this far, great. You're probably interested in programs like this. You want to subscribe, because on the next video, we're going to break down the My Choice version of the down payment assistance program. It's a little different. It offers some conventional options, but we'll break that one down on our next video. And so my time is up. I thank you for yours. Talk to you soon.